when we look at the outlook for small and mid caps, it makes sense to look at few fundamental variables. So some of the key metrics which would have an influence on the outlook is one, how the flows have shaped up in the past and how the earnings in that cohort has behaved in the recent times and how they are likely to perform. So when we look at the flows into the equity markets, so especially the last few years, the flows have been predominantly driven by domestic institutional investors. Foreign portfolio investors have been selling, as you can see in this slide. There have been bouts of selling at a regular frequency over the last few years. And FPIs typically tend to invest more in large cap and less in small and mid cap. And therefore, large caps have seen some bit of outflows, and therefore their valuations are still around reasonable levels. So when looking at the domestic mutual fund inflows, the flows have been fairly strong. So in the last 11 years, we have got $179 billion of inflows, which has been very strong. And this has gone into equity markets, and a lot of it has gone into small and mid cap stocks. If we look at history, there have been periods where we have seen prolonged years of muted flows or even outflows, like the one which we have circled in this slide. You would see that there has been about 11 years of period where we have seen a net outflow of $4 billion, and there have been very sporadic inflows in that prolonged period. And how the domestic flows have panned out into mutual funds. As you can clearly see, this is a slide where we have plotted inflows into large cap fund and inflows into mid and small cap fund. The orange line clearly shows the flows into mid and small cap funds have been on a higher side. Large caps form predominant portion of the profit pool, and therefore they have better capacity to absorb flows, whereas mid and small cap is a minority in terms of profit share, and therefore their capacity in terms of absorbing those inflows is quite limited. So what would happen as a result of this? The valuations tend to remain elevated. So here you can see the mid cap PE is still at a premium to large cap, and it has to come down by another 20-25% to reach the large cap PE. And this is the price earnings ratio on a 1 year forward basis. And what we can see in history is there has been periods whenever there is stress in mid and small caps, their PE tends to converge with the large cap PE. So if we were to believe that trend is to recur, the downside from the current levels could be another 20-25%. Now, looking at the profitability, so this is the data over the last 2 decades, where we can clearly see the profit share of small and mid caps is at about 35%. It's at about 41% as seen in the second table, which is the lowest in the last 2 decades, whereas their market cap share is at 35%. So this is data as of the calendar year end, but even with some bit of correction, which we have seen in the last few months, the valuation still remains elevated, as you can see in the previous graph. So the profit share is at the lowest point, the market cap share is at a highest point, which means there is still some bit of valuation discomfort there, and which can lead to some more correction in that space. And this combination is the exact reverse for the large cap universe, where the profit share is at its highest share, and whereas the market cap share is at its lower share, for reasons which I explained in the initial slide. So that is the broad outlook for small and mid cap. Our sense is there is still some bit of froth there in certain segments and stocks, and you can remain cautious in terms of allocating to small and mid cap funds in the near term. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.